Okay, now we're going to be looking at source document and the various journal books, or what they call original book of what? Entry. Now, what are the source documents? We have them listed here. There's receipts, there is checks, there's invoices, there's debit notes, there's credit notes, and there's what? Statement of accounts. Now, let's start with the receipts. Receipts and invoices are similar, or there's differences. What do I mean? You only issue a receipt when payment has been made for debt owed. Let me repeat. You only issue a receipt when payment for goods supplied to another person has been paid. But for an invoice, you don't need to make payment. The customer does not need to pay you. What do I mean? The customer may be owing you money, that means he hasn't paid, but you issue what is called an invoice. Why are you issuing the invoice? To show the details of that goods. How much the person bought, the quantity, the price, the total amount, the damaged goods, and all those information are gotten in the invoice. So the slight difference, you also have some of those information in receipt. But the difference between receipt and invoice, this is usually given, always given after payment has been made. The payment could be in cash, in credit, in checks, or transfer as we have it. But for this, you don't need to make payment before this is issued to you. It can be issued to you immediately as you are getting delivery of the good. You also be getting your invoices. So please take note. Issued when payment is made, not necessarily issued when payment is made. So please take note. Then checks. Checks are like if you have a bank account, they will give you what, depending on the type of bank account you have. Not all bank accounts can be given checks. You are only given checks when you have a current account. So please take note. Check is also a form of what? Source document. Now, why are all these called source document, you may ask? It is called source document because it is from this information here that will be used to what? Generate or record or get entries into this journal and ledgers, which we're going to look at later. So please take note. Information, they are called source document because it is out of here information is extracted and what? Entered into the journal and posted to the what? Ledger. So please take note. Then the next one, debit and credit notes. Now, the difference between these two, this one is used to correct an undercharge. This one is used to correct an overcharge. What do I mean? In this one, if the actual amount that's supposed to be in an invoice is 6,000 naira, but mistakenly, maybe due to while rushing, pressure, a lot of mistakes will come up. The person recorded 600 naira. Actual amount, mistake or posted amount. So you can see there's the difference of how much? 5,400. That 5,000 difference of 5,400, which is 6,000 minus this. A debit note of 5,400 will be sent to correct what? This undercharge. But for a credit note, it's always issued when there is an overcharge. Let's say for instance, the same amount, 6,000 naira, was the actual amount. But mistakenly, or maybe dubiously, because at times it may not be mistake, dubiously, the bookkeeper recorded 60,000 naira. This is the actual amount, this is the mistake or misposted amount. The difference is how much? 54,000. That means it was inflated. This invoice was inflated by 54,000 naira. To correct that inflation of that invoice, a credit note is issued to who? To the customer. Then statement of account. What is that one? Statement of account is an account. Now, a good example of statement of account is this. Your bank transaction, even now, presently, there are some codes you press that will show you your what? Transaction from the beginning, maybe from the beginning of the month till the end of the month, depending on what you're requesting, or from beginning of the year to the end of the year. This statement of account will show you money coming in and money going out. That is, if you pay money or somebody else paid money into your account should be what? Debited or credited? Okay, credited, yes. Your account should be what? Credited. But if you are withdrawing from that account, your account should be what? Debited. So those transactions, debit, credit, are what is called statement of accounts. Gotten that? Okay. Now, these are examples. They are not exhaustive, but these are just the basic ones that you should have in mind. Source document. Now, out of this source document, information are now extracted and generated in what is called journal or day books. So they have two names, journal or day books. Now, what is the essence of this journal? Every day transactions are being made, which are generated in this, which are documented in this source document. And out of it is generated in this journal. There is what is called sales day book or sales journal, purchase day book or purchase journal, return inwards and return outwards day book. Now, what is the difference between this and this? This return inwards, another name is sales returns day book or journal. While return outward is purchase returns or what? Return outward journal. Why did I call it purchase returns? Because when consumers purchase, or when you purchase something from a supplier, sometimes some things may be damaged, some things may not meet your specification and all those things. You will now return, you will record them in what? Return day book. That means when you return it to the supplier, it will be recorded. The actual amount of the good or the nature, maybe you bought 50 quantity of something, you now return 3. Maybe those 3 were not to your satisfaction or to your specification. You will now issue out what is called a return outwards day book. But for this one, return inwards, it's always issued when customers are returning back to you. So take note, this one, when you are returning to customers, suppliers, this one when what customers are returning to you. Then these ones are usually when you make sales on credit. Take note, all these things except cash book, they do not involve what? Cash transactions. It's only cash book that involves cash transactions. And cash book has dual function. It performs the function of a journal or day book and also a ledger. So this is the only book that performs what? 2 functions. And what are the 2 functions? It functions as a what? Journal. It also functions as a what? Day book. So take note, this one is only used to record sales credit, credit on sales. This is used to record what? Credit purchases. Then this one, all other items that is not recorded here, like fixed asset buying, opening balances, closing balances, those ones are recorded in the general journal. Then the cash book, as the name implies, cash book for recording cash transactions. That means when you collect cash, either in physical cash or check, they are recorded here. Or you give out cash or check, they are recorded here. So please take note, this is the only what? Book that involves what? Both a journal, and that is both a journal and a ledger. So thank you. Now, we have a transaction in the books of Jonathan. Now let's read it together to illustrate our journal entries. How do we pass entry into the journal? Enter the following transaction in the books of Jonathan. On January 1st, let's say January 1st, 2000. Everything happened 2000. Jonathan bought goods worth 10 kg at how much? 15 naira from Lopez, less 5% discount. Now, what kind of journal do you think will enter this transaction, this first transaction? Is it sales or purchase or return inwards or return outwards? Okay? Keyword there is what? Bought. And bought is usually associated with what? Purchases. That's another name. Purchases. So it will be in our purchase journal or day book. Now, this is a specimen of the purchase journal or day book. We have the date column, particular column, folio column, details, and the amount. We will now come under the details. The date, we'll write the date, 2000, January what? 1st. And what were the particulars? But what, how much? 10 kg at 15 naira per kg. Under the folio, there's no reference point here. We will now come under the details to make our calculations. And what are the calculations? If each kg costs what? 15 naira. 10 kg will be what? 50 times 10 kg. And what would that give us? That will give us 500 naira. But let's not forget, on the next line, they said what? Less 5% discount. We will still come under the details. Less 5% discount. And what are discounts? Discount is just reduction in the price of what? Goods. What is 5% discount? We'll calculate the 5% on this amount that should have been paid. So 5% of 500 naira. And how much is that? Very good. 25 naira. So we have 500 naira minus 20. Why are we minusing? Discount is a reduction of this amount. So we need to minus this amount of discount from the total amount that should be paid. And what do we have there? 475 naira. Any question? Very good. Hope you understand. January 1st, the year 2000, the date particulars is bought goods worth 10 kg at what? 15 naira per 1 kg. Then folio. This is a reference point. As you go along under the ledger, this one will be better explained. It's called a reference column. Then under the details, we calculate each 50 times 10 kg, which is what? 500 naira. Then less 5% discount, which is reduction on the amount you are supposed to pay. Come here, less 5% discount, which is 5% of 500 naira. And that is what? 25 naira. Minusing, what do we have? 475 naira. But now, they came on January 2nd. They told us, out of these goods, Jonathan returned goods worth 3 kg at 15 naira to who? Lopez. We will now come under the what? What kind of journal will we make? Return outward or return inward journal? Very good. Return outward journal or purchase return journal. We'll come under the dates. Please, we are not going to record it under this purchase journal. We are going to record it under the what? Return outward journal. January 2nd, still 2000. How many goods returned? Goods worth 3 kg at 15 naira per kg. And under the details column, it will be 50 times 3. And what is 50 times 3? 150 naira. So take note. Under the dates, this date was January 2nd. And what were the particulars? A return goods worth 3 kg at what? 15 naira per kg. Then what was the amount? 3 times 50, which we did there, and which is 150. So please take note. Amount, date, particulars, folio, details, and what? Amount. Now, this is another transaction involving Adebayo. Now let's enter the following transaction in the books of who? Adebayo. January 1st, sold 5 dozens, worth how much? 150 naira per dozen. To who? Amila. Less 10% discount. Now, what kind of journal would we record this? Very good. Sales journal or sales day book. Now, the details is still similar to the ones we just did. Purchase. Dates, particulars, folio, details, and what? Amount. We will now come under the dates. We can put year 2000 here. January 1st. And what are the details? Sold 5 dozens, worth how much? 150 naira per dozen. And how much is that? Will come under the details column, which is 5 dozens times 150 naira. And how much is that? 750 naira. Then less the 10% discount. Less 10% discount. How would you calculate the discount? The way we calculated the purchase journal, under the purchase journal. 10% of this amount that should have been paid by the customer. And how much is that? That is 75 naira. Now, 75 naira minus it from this 750 naira. How much do we have? 4 here, bring it here, 5, 6 here, put that one here, 14 minus 7, 7, then 6. So the actual amount is 675 naira. Got it? Very good. Now, January 2nd, this same Amila returned goods worth 1 dozen. That means out of this 5 dozen, she returned 1 dozen. Now, how do you calculate that? We come under the date again, January 2nd, under the particulars, return of 1 dozen by who? Amila. And under the details will come 1 dozen times what is the price? 150 naira. And how much is that? 150 naira. So that means Amila returned goods 1 dozen, which is at 150 naira, which is equals to what? 150 naira. Very good. So looking at it now, you can see the dates, the amount, the discount, and the details, and under that the amount. So we'll still look at the next one in a few minutes. Okay, now we're going to look at the last 2 sets of what? Journal. The general journal, or the journal proper as they call it, and the cash book. Now, look at this transaction. Enter the following transaction in the books of book. Shola, January 1st, bought equipment worth how much? 50,000 naira. Now, they did not say goods, they said equipment. Please, there are some technical terms you should note in accounting. If they said bought goods, that means that is what the person is trading on. E.g., for instance, a tomato seller, what is the item of merchandise? Tomato. That means if you are saying stock or goods of tomato, you should be talking of what? If you are saying stock of a tomato seller, that is the tomato is trading. But if they said the tomato seller bought, let's say for instance, bench. Bench is not what the tomato seller is trading on. Bench, you can see bench as an what? Equipment. Because of what? That is not what he's trading on. But if they say tomato, your mind should go to what? Stock or goods. That is what the person is trading on. So those are the technical terms. So please take note. Bought equipment is different from bought goods. So how much was the equipment? 50,000 naira. We will now come under the general journal column. Under the general journal, date, but we will come with the date first. Still year 2000. January 1st, bought equipment. And how much was equipment? 50,000 naira. So please take note. Then, January 2nd, they said sold goods by cash. Please, there's a difference between selling goods by cash and by credit. When it sells goods by credit, it will be recorded under the sales journal. But when the goods is sold by cash, it will be recorded under the what? Under the cash book. Please take note. Goods sales by cash, sales or purchases by cash will be recorded in the cash book. But sales or purchases by credits will be recorded in both the sales and the purchase journal. So we'll come. Now, this is a specimen of 2-column cash book. There are 3 types of cash book. There's 1 column, there's 2 column, and there's 3 column. This is a good example of 2-column cash book. Under the 2-column cash book, we have the cash and the bank column. Both on. Now, if you take note, I used 2 lines to demarcate. What this means is this is the debit side of the cash book. The debit side of the cash book starts from here. Date, particular folio, cash, bank. It stops here. Then the credit side of the cash book starts from here. Date, particulars, folio, cash, bank. So please take note. Why do we demarcate it with debit and credit? When cash or check is coming in, we what? Debit it. But when cash or check is leaving the business, we what? Credit it. So now let's look at this. Sold goods by cash, 10,000. When you sell, is money coming in or going out? Very good. It is coming in because the customer is going to pay you the money for the what? Goods. We will now come under the date, January 2nd. Particulars, since it is sold, will come sales. Then under the folio, that is a reference column. We'll leave that. Then cash, how much? 10,000 naira. We are not recording it under the credit because money is not going out from the business. Instead, customer is paying the business, money is coming in. So that is why it is recorded on the debit side, which starts from where? From here and stops here. But for a 1-column cash book, we will not have cash and bank column. What we will have here is amount column. Instead of these 2, we only have 1 what column? Amount column here. Here also, instead of these 2, we have only 1 column. Amount column. But if it is a 3-column cash book, here we will have discounts allowed on the debit side. Then on the credit side, we have discount received. Why are we having discount allowed here? Discount received here. We're having discount allowed here because discount allowed is discount given to what? To the customer. And if it's given to the customer, is that an expense or a revenue to the business? Very good. It is an expense. So that is why it is put on the debit side. Gotten it? Okay. Now, discount received is an income to the business. Why? It is the discount you get from the supplier, from outside people to you, the business. So it is an income or revenue. That is why it is put on the revenue credit side. Gotten that? Okay. So thank you.